Okay, so on the line with us today is Joe Czempoyesh from Assured Mortgage Services. Joe's been a broker for what, like 30 plus years. And Joe's got his finger on the pulse of absolutely everything when it comes to mortgages and what you should, what you shouldn't do. He's got all kinds of advice. Joe, thanks for coming on today. Now, a lot of people are talking about fixed rates. Rates are climbing. Should I be in a variable? Is it too late to lock in? These are all the questions that we're getting asked right now. So when somebody comes to you, let's even just start there, fixed or variable. What are you recommending to people if they're coming to you today and going, holy cow, what should I do?
Thanks for having me, Ken. Well, the first thing that I do is try to establish what the individual knows about fixed versus variable and what they are. There's a lot of different conceptions, misconceptions, proper conceptions about what a variable rate is versus a fixed rate. So the first thing I like to establish is, what do you know? And then, from there, basically a fixed rate is something that we set for a set period amount of time that your payments don't change and your rate remains the same. A variable fluctuates with bank prime, usually at a discount from bank prime, and then tends to fluctuate with the Bank of Canada prime rates. Not always, but that's how it goes. The other misconception that people have is that mortgage rates being fixed and variable move at the same time, and they are quite independent of each other. So there's a lot to go on that type of stuff, Ken. But I think for the first off is what do you know? What do you know about fixed versus variable? A lot of people that I deal with or have dealt with in the past think that the variable rate, as it moves, when you can lock in or convert a variable rate to a fixed rate, and they think that they can lock in at whatever the variable rate is at the time. And actually what you're locking into is whatever the market rate is on either the 3, 4, or 5 year fixed rates at the time. So that's first. The second thing is we go through getting to know our clients is that what is their appetite for risk and what is their financial ability to kind of take on risk. Variable rates are risky because they tend to move around. Fixed rates are more stable. So I think first off is that's what I established. What do we know about fixed versus variables? What are our appetites for risk based on those two situations? And what is their ability to weather any storms if there are future rate increases? So that would be the first thing, Ken. I think to elaborate on that, where are we now? Well, heck, I mean, last year, the Bank of Canada rate the overnight lending rate was 0.25% last June, 2021, and we're at 3.75% now. So that's a heck of a lot of distance that we've covered from almost nothing, right?
Yeah.
We were almost at zero, and relatively speaking, wow, we've come a long, long way.
That is the point too, though, is that it was almost at zero, and those were unheard of levels prior to this time in history.
Yeah, and I think it somewhat paints a picture for, this is a very big subject, and it's hard to condense it down into a brief video explanation, but I'll do my best to paint the picture of where I see our economy right now and where I see rates going. And there's a should have been, and there's an actual where it's going to be. And hindsight will tell us what the actual is going to be. But there is a should have been picture or should be picture right now. So we've seen, the Bank of Canada and our federal government and everybody in play here combat what we felt was going to be a very, very bad economic situation with the beginning of COVID. When we thought, holy cow, we're now getting into deflationary kind of environment where we thought, well, we better do something and add some stimulus. We had some money injected into the economy. We had rates being reduced. We had a lot going on to kind of set it so that we didn't head into a recession back at the beginning of COVID. And that didn't happen. So, kudos to them for pulling that off. What we saw with that was that it took off. So it's very much like an accordion. As we try to kind of get things in play, things can kind of be nice and easy, and then they can go wide and they can come back in, and trying to keep that in check is pretty tough. But so far throughout the COVID era, we did a pretty good job of keeping the economy in check. Last year, what we saw was and we follow a lot, the Federal Reserve in the States. I mean, there's a lot of countries that haven't followed suit. Canada has followed suit with what they've done with interest rate fluctuations. I think properly, we haven't, our dollar and everything is doing pretty well, relatively speaking, to a lot of places in the world. So where are we today? Well, we're at this point where last year what we thought was that this inflation that's getting out of control is something called transitory. That was the buzzword of the day last year, and in both the Federal Reserve in the States and our federal government and Bank of Canada thought that that was actually the case. And then, wow, we went from transitory, which is something that's going to go away when COVID goes away, to this word called sticky now. So now we have sticky inflation. So we went from transitory to sticky, and boom, we have, a prime rate at all the banks at 5.95% now. It's gone up a whole heck of a lot since December. So this is all talking about variable rates and what happens now. It's kind of, we have June of this year, we had an inflation rate 8.1%. It tends historically to hit its peak halfway through a recession if we're doing anything to kind of change things right now. We've seen a little bit of pullback. Bank of Canada still bumped the rate a half a point the last time it met, with a message that, hey, don't get too comfy. December's coming quickly. We went bump again. So when I'm having these kind of discussions with my clients, it is basically what happens if, can you weather the storm of a rate hike? On the other hand, when and if and when will it kind of come back to what we would consider normal? And what do you consider normal?
Yeah.
Well, do I consider 2% normal? Well, we went through a heck of a lot of economic upheaval when we had the stock market crash in 2008. In August of 2008, the prime lending rate was 6%. We're kind of hovering around 25-year average rates right now. So we're kind of really normal.
This is normal, but we've just come through a decade of major rate reductions to keep the economy afloat. And so now we've got a whole generation of people that are used to those really low rates, but it is not historically normal.
Yeah. So normal is, we're creatures of our current environment. Well, what's normal to you? What's normal, objectively speaking? Well, we don't really know what the new normal is, but we can kind of guess as best we can.
Yeah.
And I think for the most part, a lot of times what I do is have these kind of discussions. I get people, if they're, depending on when their window of when they're going to have to pull the trigger on choosing fixed or variable, do some homework, watch some business news network, follow a couple of economists. Benjamin Tal at CIBC has always been a major guy in the mortgage world kind of thing to kind of communicate on this very topic. So the thing that I like to do is get some people aware of, hey, why would it go this way, or why did it move this way? And do I believe that strategy is correct for me? So, if I look at going forward, what again goes back to what should happen, things should settle out to our new normal next year. Maybe that's a 4% prime lending rate. That's been kind of talked about quite a bit. That might be the new normal, the new settle. And then how much time transpires between the now and then, and maybe locking in for 2-3 years, 5 years in this new normal period, give it time to settle, isn't a bad thing, but again, it's kind of like, do we get into the variable rate? Do we think that things are going to settle and come back down? Do we think they're going to continue to go up? Where are they going to be? And where's the new normal? And that's the kind of the $1 million question, right?
Okay, so give me the answer to the $1 million question then. So what do you think? So say I'm a client that comes to you. I've decided I'm going to lock in. I'm going to take a fix because I want some certainty in my paycheck, which a lot of people do. They want to have that. They aren't risk takers. They're a little more risk averse. The average person is. Are you encouraging people to take a 3-year, or are you encouraging people to take a 5-year fix today?
Well, the real thing there is, what is your appetite for risk? Do you want to set it and forget it? And what is your, there's a few factors there to consider. Just saying that, what's your appetite for risk? What is your ability to handle risk? If you're tight already, if you can't afford to get the kids into hockey because the mortgage payment's putting the pinch on your wallet, you got to lock it. You don't have the ability, or you can't afford the risk if the rates go up and your payment goes up and now you can't you're having a hard time eating, so to speak, if you will.
Right.
There are other people that have, I don't want to say limitless, but the situations are a little bit different. Maybe the amount of the mortgage relative to your overall net worth and portfolio is relatively low. So these are the kind of things that I definitely look at with people. And then having said that, so let's look at a couple different situations. Let's just say that your mortgage payment right now is set at $2,500 a month. And if it went to $3,500 a month, it really wouldn't bother you that much. If that were the situation, what should happen, I think, is the rate should normalize. We've seen a 0.5 point bump from the Bank of Canada at the last meeting. I think we may see a little bit more, but I also believe that they're getting the indication in that the inflation is starting to come back. I don't think it's going to bounce back to 2% nearly as fast as what they would like. But I think that things should normalize. The other thing that I would want to comment on is that our federal government has seemed to take notice that, the last budget that came out, they said, we're going to inject a lot of stimulus into the economy. And the Bank of Canada said, hey, that's kind of counter to what we're trying to do here with curbing inflation. So we've seen things like the foreign buyer ban in 2023 come into play, and a postponement of some of the new stimulus packages that were to be injected into the economy. So wake up and take notice from the federal government that stimulus might have something to do with inflation is encouraging to me when I see that rates should be coming down back into that should pile, right? So what I believe should happen is that rates should start to inflation. We should see some indicators that inflation is coming into check. I don't think anybody thinks it's going to be 2% anywhere, anytime soon, and there'll be a new normal. So if I was on that strategy, I would go variable until things normalized a little bit, but I would be more encouraging people to do that if they could weather the storm, because I still think we have room to go up before it comes back down.
Got it.
Now, there's a lot of different factors that can play into that, and the rates go the other way, right? And back to that accordion thing is that we're doing a pretty good job keeping that from going to wow out and in. And major fluctuations in that can send rates up. And, I would just know yourself, know your situation. I think things should normalize into 2023, and we should see things start to stabilize. But, again, that's the $1 million question, right? So
yeah,
if that makes sense too, Ken, I'm hoping I'm trying to cram a lot into my brain here and get it out, articulated properly. But if you're tight on the, if the wallet and the monthly cash flow is tight, you just don't have I don't think you have the ability to risk it if rates go up. I think that people are, maybe not too many people, but some people are on the verge of maybe having to sell their houses because they can't afford the monthly outlay. And depending on who and what you are within that, I don't think that there's going to be any landslide win to I went variable and I locked into 2% again. I don't think that's going to be the case. So I think what we are going to see is a much tighter margin between the fixed and the variables over the next 3, 4, 5 years. So I think that is something to consider as well. I think another factor to consider is that if you are in a variable rate mortgage, if you were to move or to have to sell your property or do anything like that, the maximum penalty on a variable rate mortgage is 3 months interest. So it becomes easier to move in and out of. Contrary to that, if you're in a fixed rate mortgage and rates are up and then rates come back down, the penalties to break those are much, much larger. Yeah. Maybe topic for another discussion, but penalties and flexibility do come in to the individual situations, their appetite for risk and their ability to weather storms with interest rate changes, I think is important to really kind of talk about with people.
We're talking to Joe Czempoyesh from Assured Mortgage Services. Been a broker for 30 plus years. He's weathered all kinds of storms himself. He's been through a bunch of different market situations and a bunch of different ups and downs in the market. Awesome guy to talk to if you want to get into the pros and cons of mortgages. Really what you're saying is it's up to the individual, and everybody is absolutely different when it comes to taking a mortgage for a home, correct?
Absolutely.
Awesome.
Absolutely.
Awesome. If people want to get a hold of you and they want to talk to you a little bit more about it, how do they do that?
Email is joe@biggerpiggybank.com. Phone is 403-975-6399.
Joe,
Nice.
always awesome to talk to you. We really, really appreciate it. And we will chat with you again very soon.
Ken, thanks for having me.